Okay, let's unpack this. Welcome to the deep dive. Today, we're digging into a pretty hefty stack of sources, specifically the JP Morgan Guide to the Markets, the US edition. This is for the second quarter of 2025, and the data is current as of May 22, 2025. Our mission, well, it's to slice through all this data, pull out the essential stuff, maybe some surprising facts, and just get you the key insights on US markets and the economy, all tailored for you.
Yeah, and what's really fascinating here is just the sheer density of information in this report. It's packed. Our goal isn't, to read you the whole thing cover to cover. It's more about synthesizing these different data points. You've got stock charts, labor stats, bond yields, global stuff, and helping you understand not just what the numbers are saying, but why they matter, how they connect to that bigger picture right now.
Absolutely. So let's jump straight in. Equities first, the stock market, always a big topic. The S&P 500 index level, as of that May 22nd date, was sitting at 58 of 502. Now that's a number, but what does it actually tell us about where the market is, historically?
Right, and that number immediately brings up valuation.
Yep.
How expensive is the market? Looking at the data here, the forward price to earnings ratio, the PE ratio, which is, how much investors are paying for future earnings, it was 21.1 times to the S&P 500 on that date.
21.1. And how does that compare to, say, the long-term average?
Well, it's significantly above it. The 30-year average for PE is 16.95 times.
Yeah.
So the sources actually quantify this. They say the market's trading 1.26 standard deviations above that average.
Okay, 1.26 standard deviations. What does that mean in plain English?
It means it's pretty stretched historically. Right. It puts a valuation in a range we've only seen maybe 10 or 11% of the time over the last 3 decades. And other measures like price to book, price to cash flow, they also show valuations above average. Dividend yield, meanwhile, is below average.
Okay. So historically, it looks kind of pricey. That raises the big question. Are earnings strong enough to justify this? What do the sources say about earnings growth?
Yeah, that's the critical counterpoint, isn't it? This report shows the consensus forecast for pro forma EPS growth for the S&P 500. It's 9.0% year over year for 2025.
9%, okay. And where's that growth supposed to come from? Is it sales or?
It's interesting how they see it happening. About half, 4.7% from profit margin expansion, and the other half, 4.4% from actual revenue growth. So a combination.
Right, a mix. And looking under the hood, are all parts of the market pulling their weight equally in that earnings picture?
Oh, not at all, no. The sector forecasts are really quite spread out. Information technology, that's expected to lead the way. 19% growth forecast for 2025.
Wow, 19%.
Yeah, but then you look at energy, and the forecast is just 1%. Very different story. Communication services, industrials, they're looking pretty solid too, around 12-13% growth expected. So yeah, lots of dispersion.
Speaking of dispersion, what about value versus growth stock? Seems like growth has been the only game in town recently.
The sources definitely touch on that. And yeah, looking at relative valuations, growth is still significantly more expensive than value. If you compare Russell 1000 value and growth, the forward PE ratio of value versus growth was 0.60. That's below the long-term average of 0.70.
So value looks cheap relative to growth, historically speaking.
Relatively, yes.
Yeah.
And while growth has delivered much higher earnings growth recently, the data also kind of reminds us that value stocks, well, they've historically shown up among the top performers each year, too. It's not always just the growth names, even if they get the headlines.
That brings us neatly to market concentration, another huge theme. Just how much of the S&P 500 is tied up in those very top companies?
This is where it gets really interesting, maybe even a little concerning for some. The weight of just the top 10 stocks in the S&P 500. It reached 37.2% of the index's market cap as of May 22nd.
37% in just 10 companies.
Exactly. 10 companies out of 500 making up over a third of the value. And the sources show it's not just market cap, these top 10. They have a disproportionate share of R&D spending, operating income, CapEx, free cash flow, sales, even employees compared to their index weight. And their combined forward PE, a hefty 26.8 times, much higher than the other 492 stocks, which were at 18.6 times.
And when we talk top names, the Magnificent Seven comes up constantly. What does the report show about how they've been doing lately?
It's actually a pretty nuanced picture. Yes, they had those phenomenal returns in 2023, obviously 76% gain.
Yeah.
But the sources show their price performance year to date through May 22nd, 2025 was actually negative, down 5.6%.
Dan, really?
Yeah, down 5.6% for the group. However, and this is the wild part, despite being down themselves over that period, they still contributed a massive 221% of the overall S&P 500's total return year to date.
Wait, how does that work?
It means the rest of the market, the other 493 stocks, must have been down even more, and the Mag 7's smaller loss still propped up the index returns significantly. Or there were some big swings within the period. It just shows their sheer influence.
Yeah.
Even their negative performance dominates the index's moves.
Okay, got it. So moving beyond those giants, how do smaller companies look in comparison?
Well, comparing large caps like the S&P 500 with mid caps, Russell Mid Cap, and small caps, Russell 2000, the sources highlight a key difference: profitability, or lack thereof sometimes. In the fourth quarter of 2024, a pretty striking 40% of companies in the small cap Russell 2000 were unprofitable.
40%, wow.
Yeah, compare that to 16% in the large cap S&P 500. It's a big gap. Now, the 2025 earnings growth forecasts are actually higher for mid and small caps than for large caps. But it's important, I think, to remember they're often starting from that lower, less profitable base.
Right, context matters. Okay, finally on equities, just looking back, the historical ups and downs of the S&P 500 itself. What's the takeaway there for investors?
Yeah, the historical chart in the report is always a good reminder about volatility. It shows that even though the market had average intra-year drops of around 14%.
14% drop within the year, on average.
Right. Despite that, the S&P 500 still finished the year with positive annual returns in 34 out of the last 45 years shown. It really underscores the potential resilience over the long term, even if you get some scary dips along the way.
Okay, good perspective. Let's shift gears now. Away from the market itself, let's look at the engine behind it, the broader U.S. economy. How's it performing according to these sources?
All right, so the report gives us the real GDP growth data. For the first quarter of 2025, it was actually slightly negative, minus 0.3% on a quarter-over-quarter annualized basis.
A contraction in Q1.
On that quarter-over-quarter measure, yes. But year-over-year, it was still positive, 2.1% growth compared to Q1 of the previous year.
Okay. And what were the main forces driving that Q1 number, especially the negative part?
Well, if you break down the components, business fixed investment actually looked pretty healthy, contributing 1.3%. Consumption also added 1.2%. So the domestic private sector seemed okay.
So what dragged it down?
The biggest factor was a large negative hit from net exports. That subtracted a hefty 4.8% from growth in the quarter. Government spending also had a slightly negative contribution. So trade and government spending were the main drags in Q1.
Interesting. Okay, let's talk about the consumer, such a huge part of the economy. How are household finances looking, according to this report?
It's a bit of a mixed bag, really. On one hand, the overall consumer balance sheet, looking at data from the end of 2024, looks pretty strong. Total assets of $190 trillion versus liabilities of about $21 trillion. And the household debt service ratio, how much income goes to paying debt, was estimated at 11.3% in Q1 2025.
And how does that 11.3% compare historically?
It's significantly lower than the peak we saw back in the financial crisis, which was almost 16%. So overall debt burdens seem manageable.
Okay, that sounds positive, but you said mixed bag.
However, yes, the sources also point to a less rosy trend: rising early delinquency rates, that payments 30 days or more past due. On auto loans, it hit 8.0% in Q1 2025, and on credit cards, 8.8%.
So stress showing up at the margins there.
Exactly. Suggests that while the aggregate looks okay, some households are definitely feeling the pinch.
That makes sense. We often hear about consumer confidence surveys trying to capture that feeling. What's the historical link shown here between confidence levels and actual market returns?
Yeah, this is some really interesting data they include. Historically, if you look at subsequent 12-month S&P 500 returns, they've averaged much, much higher after periods when consumer sentiment was really low, like at a trough.
How much higher?
An average price return of plus 24.1% following sentiment troughs. Compare that to periods when sentiment peaked. The average return after that was only plus 3.9%.
Wow. So buy when everyone's miserable, sell when they're euphoric? Kind of.
That's what the historical correlation suggests, yeah. And consumer sentiment as of May 2025 was 50.8, which is relatively low historically.
Interesting. Okay, shifting from consumers to businesses. What role is technology, especially AI, playing in business investment? We hear so much about it.
The sources definitely highlight this. Capital spending from the major AI hyperscalers, think Google, Amazon, AWS, Meta, Microsoft, their combined spending hit $316 billion in 2024. And it's forecast to keep growing fast.
$316 billion, that's huge.
It is. And this tech-driven investment is clearly a significant and growing part of overall business capital spending, which, as we just noted, was a positive for GDP in Q1.
Right. And is this investment showing up yet in things like productivity numbers?
Well, the data on labor productivity growth has been a bit up and down,
Hmm.
volatile. The report also has some data on actual AI usage. As of March 2025, about 8% of all firms reported using AI applications. That percentage is higher in sectors you'd expect, like information and professional technical services. So the report doesn't draw a direct, causal line saying this investment equals this productivity gain yet, but it definitely shows these tech shifts are happening.
Okay. Let's touch on federal finances. Always a major background factor. What's the picture from the report on the budget and the debt outlook?
Yeah, the CBO baseline forecast for the 2025 federal budget. It's pretty stark, as you said. They project total spending around $7 trillion, but the deficit is forecast at $1.865 trillion.
So the deficit is like, what, 27% of spending?
Roughly, yeah, about 27%. And a big chunk of that spending, 14%, is projected just for net interest payments on the existing debt. That's almost $1 trillion, $952 billion.
Wow, just interest. And the total national debt itself, how's that trajectory looking?
Federal net debt as a percentage of GDP. It was 98.2% in fiscal 24. The CBO forecasts this to keep rising substantially. They see it reaching 118.5% of GDP by 2035.
Over 100% of GDP.
Yeah. And importantly, that forecast assumes certain tax cuts that are set to expire actually get extended. So it highlights this underlying structural fiscal challenge the U.S. is facing.
Right. Okay, moving to the labor market, unemployment, wages, key indicators of economic health. What are the latest numbers here?
As of April 2025, the report shows the civilian unemployment rate at 4.2%. And year-over-year wage growth, looking at private production and non-supervisory workers, was 4.1%.
So unemployment's still low, wage growth still fairly solid, suggests a tight labor market still.
Relatively tight, yeah. And if you look at the demand side, like the JOLTS data on job openings have definitely come down from their peak back in early 2022, but they're still elevated compared to before the pandemic. In March 2025, there were about 7.2 million job openings. And data on quits and layoffs generally supports that picture workers still seem to have some bargaining power, maybe just a bit less than a couple of years ago.
Okay. And on the other side, labor supply. Who's actually joining the workforce? Any interesting trends there?
Yeah, this is a really interesting point the sources make, looking at demographics. A significant driver of recent labor force growth has actually been foreign-born individuals.
More so than native-born.
Especially compared to the contribution from the native-born labor force in recent years, yeah. It's a notable shift in where the supply growth is coming from.
Okay, let's turn to inflation now. Where do the sources show price pressures are currently coming from? Still housing.
The report breaks down the components of the CPI, the Consumer Price Index. As of April 2025, headline CPI inflation was running at 2.3% year over year. Core CPI, which strips out food and energy, was a bit higher at 2.8%.
And yes, shelter costs, still a big piece of that.
Absolutely. Consistent with recent trends, shelter continues to be a significant driver, keeping that core number elevated.
Right. Energy markets are always critical, too, for inflation and the economy. What's the picture there?
Well, the data shows global trends in oil production and consumption. Interestingly, U.S. oil production is actually forecast to increase in 2025. And the price of West Texas Intermediate crude, it was $61.20 a barrel on May 22nd.
$61. That's quite a bit lower than the peaks we saw, isn't it?
Oh, yeah. Significantly down from the peak in March 2022. So at least from crude oil, maybe less inflationary pressure than we saw a couple of years back.
Okay. Beyond oil, the sources also look at electricity demand, right? Especially with things like AI.
Yeah, that's an interesting point they highlight for the future. The expected growth in electricity demand specifically coming from data centers. It's projected to become a larger slice of total U.S. power demand right through 2030. Just shows how tech trends ripple into physical infrastructure needs.
Makes sense. What about the U.S. dollar? How's it been performing?
The U.S. dollar index, a measure against other major currencies, was right up at 100.0 on May 22nd, which is quite a bit down from its peak back in late 2022 when it was over 112.
And what factors are driving that?
The report points to things like the U.S. trade balance. If we run a current account deficit, about negative 4.1% of GDP in Q4 2024, and also interest rate differentials. You know, how U.S. rates compare to rates in Europe or Japan. Those are key drivers for the dollar's value.
Okay. Tariffs have been in the news again lately. Do the sources quantify that at all?
They provide an estimate, yeah. An estimate of the average tariff rate on U.S. goods imports meant for consumption. As of May 22nd, they show that estimated weighted average rate. Gives you a quantitative snapshot of current trade friction, if you like.
Got it. And finally, on the economy, the report uses various surveys: ISM manufacturing, services, business confidence, consumer confidence. What's the overall vibe from those?
Yeah, these surveys try to capture sentiment, right? Expectations. And often the takeaway is, well, mixed signals.
Not surprising, I guess.
No, you get different readings from manufacturers versus service providers or businesses versus consumers. They provide useful pieces of the puzzle, but they don't always point in the exact same direction. Reflects the complexity out there.
Okay, let's shift gears one last time and dive into fixed income. Bonds, interest rates, heavily influenced by the Fed, of course.
Right. And the sources give us both the Fed's own view from their March 2025 projections and what the market itself was pricing in as of May 22nd. The FOMC, the Fed committee, their median forecast for the federal funds rate at the end of 2025 was 4.38%, and they see it eventually settling around 3.10% in the long run.
And what did the market think? Did it agree?
Not quite. Market expectations priced in through futures were a bit lower, 3.90% for year-end 2025. So the market was betting on slightly more rate cuts than the Fed was signaling at that point.
Interesting divergence. What about the Fed's balance sheet? They did all that QE, buying bonds, and now they're shrinking it with QT, quantitative tightening.
Exactly. The sources track that whole history, QT22. As of May 22, 2025, it had shrunk the balance sheet by about $2.2 trillion, almost $2,200 billion reduction.
And is that shrinking still going full speed?
The report suggests the pace of reduction is actually slowing down,
Hmm.
and the forecast included in the guide hints the balance sheet might sort of level off sometime in 2026.
Okay. Now, thinking about bond yields for investors, how do current rates compare to inflation? What are the real yields?
Good question. So the nominal 10-year U.S. Treasury yield was 4.54% on May 22nd. But when you adjust that for core inflation using the prior month's CPI data, you get a real 10-year yield of 1.76%.
1.76% real yield. How does that compare historically?
It's actually a bit lower than the long-term average real yield, which the report pegs at 1.92%. So after accounting for inflation, current bond yields are maybe slightly less attractive than their historical average based on this measure.
Right. And looking across different types of bonds, corporate bonds, high yield, etc., what are the key dynamics there?
Well, the report lists the yields. U.S. aggregate bond index, 4.84%. Investment-grade corporates, 5.35%. U.S. high yield or junk bonds, 7.64%. But maybe the most interesting thing is the credit spreads. That's the extra yield you get for holding a corporate bond instead of a risk-free treasury.
And what are those spreads saying?
They're saying investors aren't demanding much extra yield right now. Both investment-grade and high-yield spreads are significantly tighter, meaning lower, than their long-term averages. The report puts them in low historical percentiles, 12th percentile for IG, 16th for HY.
So investors are pretty confident about companies not defaulting?
It suggests a high degree of confidence, maybe even complacency. Yeah. And consistent with that, actual default rates in U.S. high yield are currently very low compared to their 25-year averages.
Okay. What about the shape of the yield curve? Still inverted?
The U.S. Treasury yield curve data from May 22nd shows it's less inverted than it was at its peak back in July 2023, but it's still kind of flat to slightly inverted, meaning shorter-term rates are still higher than the 10-year yield.
And that usually means what?
Historically, it's often been seen as a signal of market expectations for slowing growth or maybe future rate cuts, but it's not a perfect predictor.
Got it. Municipal bonds munis are another area covered briefly.
Yeah, the sources compare muni yields on a tax-equivalent basis, adjusting for the tax benefits to Treasury yields. It also includes some data on the financial health of states and cities. Shows that state rainy day funds were actually pretty healthy as of fiscal year 2024 estimates. Suggests some fiscal cushion there.
And just like for stocks, the report shows historical returns and drawdowns for bonds, right? Using the U.S. aggregate index.
It does. And it paints a different picture than equities, as you'd expect. Bonds are less volatile. The average intra-year drop for the U.S. aggregate was 3.5%, much smaller than the S&P's 14%. And because of that lower volatility, the index had positive annual returns in 44 out of the 49 years shown. More frequent positive years than stocks, but generally lower returns over the long haul.
Okay, now, there's some really compelling data in this section connecting starting bond yields to future returns. Can you unpack that?
Yes, this is, I think, a really key insight the sources emphasize. They show a very strong historical correlation. The R-squared statistic is 89%, which is really high, between the starting yield to worst of the U.S. aggregate bond index and the actual annualized total return you got over the next 5 years.
So the yield today tells you a lot about your likely return over the next 5 years.
Historically, it's been a remarkably good predictor, yes. Much more so than, say, PE ratios predicting future stock returns. So as of May 22, 2025, the starting yield was 4.84%. Based purely on that historical relationship shown in the report, it implies a forecast 5-year annualized return of 4.97%.
4.97%. That's quite specific, based on history. Okay, let's take a final quick look internationally before we wrap things up. How are global stock markets doing compared to the US?
Well, the report highlights some pretty stark differences, actually. Year-to-date through May 22nd, 2025. While the S&P 500 was slightly negative, 0.2% total return in USD, several international regions were showing really strong positive returns.
Like where?
The Eurozone, for instance, was up 25.1% in US dollar terms. Germany was up 31.2%, significantly outpacing the US over that specific period.
Wow, big difference. And what about valuations? Are international markets cheaper or more expensive than the US?
This is probably the most striking piece of data here. International equities using the MSCI ACWI ex-US index as a benchmark are trading at a significant valuation discount to U.S. equities.
How significant?
As of May 22nd, the price-to-earnings discount was negative 33.5% compared to the S&P 500. And that discount is substantially wider than the 20-year average discount, which was negative 18.2%.
So relative to history, international stocks look unusually cheap compared to U.S. stocks right now.
On average, based on PE ratios, yes, that's what the data suggests.
Okay. We have covered a massive amount of ground in this deep dive. Phew. From those concentrated, kind of stretched valuations in U.S. tech, the drivers of earnings, down to the details of the consumer balance sheet, those rising delinquencies, the big federal finance challenges, the labor market nuances, the inflation picture.
Yeah, and we dug into fixed income, too. The Fed's path, what current rates mean in real terms, those tight credit spreads, and that really interesting historical link between starting bond yields and future returns. Plus, looking overseas at those wider valuation discounts, and, at least recently, some stronger performance in certain areas.
How, distilling all of that, what does this mean for you, the listener?
Well, we've laid out this picture right. U.S. equities look historically expensive by many measures, and they're very concentrated. International equities, on the other hand, are trading at a historically wide discount. And in the bond market, we have strong historical evidence suggesting today's yields offer potentially decent forecasts for returns over the next few years. So here's something to think about. Given that tension between maybe overvalued U.S. stocks and potentially fairly varied or even undervalued bonds and international stocks, how do you weigh those factors? Is that historical link for bonds reliable this time? Are there unique forces, maybe AI, maybe debt levels, that make this time different? Or are these historical valuation signals, like the international discount, telling you something important about potential risks and opportunities ahead? Just something to mull over as you process all these insights from the Guide to the Markets.